Hello and welcome to Enrich Academy. Today's video is all about the Harami candlestick patterns. So without further ado, let's check out the patterns. Harami is made up of two candles and it shows a trend reversal. It can either be bullish or bearish depending on where it is within the price action. Harami is a very important candlestick pattern because this pattern can be seen all over. Whether you deal with stocks, commodities, or currency, you will be able to see this pattern. So pay attention and practice this pattern. Now remember, all these names are in Japanese, as it was started by a Japanese person. And Harami in Japanese means pregnant. So let's start with the bearish Harami. A bearish Harami occurs at the market top and must be seen after an uptrend. It starts with a larger bullish candle on day 1 and a smaller bearish candle on day 2. So here we see the first candle is bullish and the buyers were pretty strong, and this big candle may indicate that the market may still go upward. The second candle in the Harami pattern must be a candle with a small body and must be contained within the first candle's body. The second candle can either be red or green. The patterns may or may not have shadows. So how can we confirm the bearish Harami? When you see the price trade below the low of the pattern, we can confirm it. So here we see that the bulls are stronger initially, but the second candle changes the trend, making it difficult for the bulls to push the price higher. The most significant feature of the bearish Harami is that prices gapped down on day 2 and were not able to push it higher back to the close of day 1. This is an indication that indecision could be entering the market. Now, a possible sell signal can be inferred when you spot a bearish Harami pattern along with a trend line break. So let's move on to bullish Harami. It's just the opposite of bearish Harami. The bullish Harami occurs at the market bottom. It starts with a larger bearish candle on day 1 and a smaller bullish candle on day 2. And it must be seen after a downtrend. The second candle must be contained within the first candle's body. And the second candle can either be red or green. The patterns may or may not have shadows, and you can confirm the pattern when the price trades above the high of the candle here. So here we see that the bears are stronger initially, but the second candle changes the trend, making it difficult for the bears to push the prices further down. Again, the main characteristic or feature of bullish Harami is that prices gap up on day 2 and the price can be seen held up, unable to push lower back to the bearish close of day 1. Both the bullish Harami and a trendline break together could result in a buy signal. Now remember, the Harami pattern is just the opposite of the bearish engulfing pattern and the bullish engulfing pattern. The difference between the two patterns is that in the engulfing, we can see that the second larger candle engulfs or covers the first candle. Whereas in the Harami patterns, we can see that the first candle covers the second candle, and the second candle is contained within the first candle. For a detailed idea on the engulfing pattern, do watch our video on engulfing patterns. The link is provided in the description box below. Now remember to be cautious and do not take position as soon as you spot a Harami, as it is not considered a strong pattern by many traders. It is usually considered to be a reliable reversal pattern in bigger time frames like weekly and monthly. But remember to always place a stop loss whatever the time frame you choose to trade with. Now let's move on and try to understand the Harami cross. The concept is the same as bullish and bearish Harami. The bullish Harami cross is a bullish reversal pattern and appears after a downtrend. The first candle continues the trend and the second candle is a doji contained within the first bearish candle's body. Now this pattern is considered to be more important than bullish Harami pattern. Now you can confirm the pattern by spotting a bullish candle next to the doji candle, and a large gap up or a higher close confirms the bottom. Some traders give more importance to a bullish Harami cross if it is seen at a support level apart from other technical indicators. The bearish Harami cross appears after an uptrend with the second candle forming a doji pattern and contained within the first bullish candle's body. The traders give importance to this pattern if it occurs close to a major resistance level. So let's try and understand the Harami cross better. A bullish Harami cross pattern forms after a downtrend, and the first candlestick is a long down candle, typically a red candle, or it can be a black candle depending on your charting platform. Now this clearly shows that the sellers or the bears are in control. The second candle, which is a doji that looks like a cross, opens above the previous day's close. Now as you know, the doji closes near to the price it opened at, and it must be completely contained within the real body of the previous candle or day one's candle. The doji shows that some indecision has entered the minds of sellers. Usually, traders don't proceed on the pattern unless they see the price moving up for the next couple of candles. This is how you confirm any pattern, by waiting for the next few candles. At times, the price may break for a few candles after the doji and then climbs or drops. If the price rises over the open of the first candle, we can confirm that the price may be moving higher. Now, a bearish Harami cross forms after an uptrend. The first candlestick is a long candle, usually a green candle or a white depending on the charting platform, and this pattern shows buyers are in control. It's followed by a doji again, which shows clearly that there is an indecision on the part of the buyers. Like the bullish cross, the doji must be contained within the real body of the first day's candle. Now, the confirmation of bearish Harami cross can be done when we see a price drop after the pattern. But if the price rises after the doji, the bearish cross pattern becomes invalid. Now, when placing a stop loss for a buy position, it can be placed below the low of the doji or below the low of the first candlestick. An entry can be taken when the price moves above the open of the first candle. When trading with Harami cross patterns, traders need to use some methods to decide when to exit a profitable trade. Some traders use a trailing stop loss, retracements, or some use the risk to reward ratio. Now, what's important is to practice with the previous records of candlestick patterns of the previous market sessions. But always remember, no pattern is 100% foolproof. All these are probabilities. So always make sure the prices are near the levels. Do not trade with your emotions. Learn to control your emotions, be it a long candlestick or a short candlestick. It doesn't matter. You need to work with the levels. And if you use all the patterns along with the support and resistance level, then it can be termed as a high probability trade. Your possibility of making an error would be less as compared to when you don't use support and resistance level. So train your eyes to spot and identify the various patterns. So I hope you now have an idea of the Harami candlestick patterns. If you found this video useful, please do like and share, and do subscribe for regular updates. Thank you.